What is going on, everybody? Welcome back to my channel. I'm Tyler Cobble, and today we're going to be talking about underwriting commercial real estate investment deals. I get asked this question all the time. How do you properly underwrite commercial real estate investments? It can be very difficult, and the issue that I've had with a lot of the softwares that are available out there is that they're either way too expensive or they're incredibly difficult to use. So I actually partnered up with Bruce Petersen, the apartment guy. He had an incredible multifamily spreadsheet that he uses to underwrite all of his investments. And we decided to kind of tailor that to do commercial real estate investments as well. So today I'm going to show you guys the software that I actually utilize to underwrite every commercial real estate opportunity that I've ever bought, whether it's office, retail, industrial, does not matter. This will work for them. I'll show you kind of how I go through that process. We'll also talk about what to look out for when running your numbers. You know, what operating expenses should you keep in mind? How should you calculate your rent increases? Determining what the market's doing. And then I'm going to show you how I'm underwriting during a crisis or a pandemic. That's obviously a very hot topic right now, considering where we are in the world. And in my opinion, there is a very, very different way to underwrite when you're going through a pandemic than there is in a normal market. So let's go ahead and dive right on in. So this is the spreadsheet that I use. As you can see, it's relatively simple. This is available for sale on my website now. If you go to tylercobble.com/models, we do have this fully available to you. Again, the reason that we wanted to do it is that most of the issues that I had seen with all these spreadsheets was that they were just too complicated. So, this is relatively straightforward. And I'm just going to kind of walk you guys through. I'm going to be using a property that I'm actually looking at in Chattanooga as the example property here. And let's go ahead and get it going. So up here, you just kind of change the property name. So let's just call it 123 Main Street. That way I'm not giving away what the property is. All right. So right here under the deal, you've got the square footage of the property. So all you do is simply input the square footage. So this building's about just under 42,000 square feet. We are actually going to be buying it for $1.8 million. Again, super easy. You just input whatever your price is for a property. Capitalized rehab. So I've done a lot of rehabs on commercial properties. We just finished up a couple here recently, so I'm pretty well versed on numbers. If you don't know how much it's going to cost to rehab the space, you will have to go through that process with your contractor prior to properly underwriting it. Now, if you have kind of an idea of what you're doing, you'll be able to just throw a number in based on a price per square foot, which is what I would be doing. So right here, our budget's actually $1,250,000 for this building. So just input that, which comes out to be about $30 a foot. Contractor thinks that we can get it done for $20 to $25. I like to be a little conservative on this and underwrite it a little bit higher. To put this in perspective, he said that for $35 a foot, we'd basically have a brand new building. Now, one thing I'm sure you guys are probably noticing is that it says $43 a foot on the acquisition price, and that's really, really cheap. I mean, honestly, we couldn't buy it for we couldn't buy the land and build it for 4 times that. That's the opportunity that you have when you find deals off market in these tertiary markets. So I love Chattanooga. It's growing really quickly. It's located, halfway between Nashville and Atlanta. And so we're really excited about the opportunities out there. Now, the reason this says capitalized rehab is that will be part of your loan. So you're actually going to be getting a construction loan for that. We have non-capitalized rehab in here as well. If you're planning on bringing some cash to the table instead of getting a construction loan, I don't typically do that. But you have that option here if you do want it. Closing costs, I typically estimate those to be right around 1%. It's going to depend on the deal. If we're doing a syndication, obviously our closing costs will be a little bit higher, because we'll spend, between $10,000 and $15,000 on legal fees just to get the PPMs put together. But 1% is a pretty good number. And so that generates your operating capital based on the financing. So I actually skip over these two and come right down here to financing. and look at this. And, based on this type of product, I've already had a conversation with my lender. So that's one thing that you will want to do whenever you are going through this process, is having a conversation with your lender before you go through the underwriting, so you have a general idea of what to look out for, and what you can expect in terms of a down payment, interest rate, and even term. Sometimes there could be an advantage to doing a 15-year term, and you may get a lower interest rate. So there's definitely some options you want to look at there. We will be coming in with 20% down on this project. Interest rate, I'm actually expecting that to be at around 3.9%. And I'm expecting the term to be about 20 years. Now, that doesn't necessarily mean that it is fixed for 20 years. That's just the amortization that I'm expecting on this project. So that gives you your debt service. You can see it broken out by principal and interest there as well. That's going to come in handy later on when we start talking about interest-only periods. Now, under the operating income, this is where I input what I expect the rents to be. So for this property, most kind of Class A or recently renovated office spaces are trading for around $20 to $25 a foot, full service in Chattanooga. Now, I got that because I own a commercial real estate brokerage. It's very easy for me to go in and find that kind of data. If you don't know those numbers, highly recommend getting in touch with a broker in the market that you're trying to buy in, or you could just start calling around on listings to see what is available. Now, I like to bring my projects in at well below market rates. This is going to be a BRRRR strategy. So, the whole point is to buy it, rehab it, rent the property, then refinance it, pull all of our cash out, and move on to the next project. So I prefer to do that very quickly because I get velocity of capital. So the more aggressive my rate is on the rent side, the quicker it will lease up, because tenants kind of look at the property and they're like, well, obviously, if you're comparing apples to apples, they're going to pick the cheaper one. So instead of going in at $20 to $25 a foot, I'm actually going to bring it in at $16 a foot, and let's see if we can make that work. So this then shows you your gross potential rent. This is broken out over 5 years, which is a pretty good snapshot. We do have some spreadsheets that show 10, but honestly, pro formas are really just calculated guessing machines anyway. So after 5 years, the chances of you being remotely close to being correct are very slim. So I typically just do 5 years. Now, I do have under here a vacancy loss. You'll notice that is very high the first year. I actually come down to the spreadsheet over here, and I have my vacancy rates. So you can change these based on year, and it obviously will impact the amount of income that you'll have coming through, because you're not going to have 100% occupancy the first year. So I would say so the building is 100% vacant at the moment. It's going to take us probably, I'd say, 4 to 6 months after permitting to go through the rehab. So that's 50% vacancy no matter what. And then there's no way that we're going to be able to fill up the building after that. So I'd say 90% vacancy in year one is pretty good. Basically we have to lease 8,000 square feet for the remainder of the year, or a little bit more. Year two is probably 35%. That's saying that we've gotten over half the building filled within 2 years. Now, based on absorption rates in Chattanooga, and again, similar projects that we've worked on, that's more than feasible. And then what I like to do with vacancy rates is go in at about 2% above market vacancy rates. So I noticed that office vacancies in Chattanooga for higher end office space, again, you want to compare to comps. You don't want to just look at, general office, because general office in Chattanooga is much higher vacancy than what we're looking at here. But so it's closer to that 5% mark. So I think 7% is, again, conservative. One thing that you'll realize that I do whenever I'm going through all of my underwriting is I'm very conservative, and sometimes I'm conservative to a fault. But I believe that when you're going through this process, you have to be. You have to be very conservative, because if the deal works conservatively, it will work if you get everything right. And I would rather bet on everything going wrong and the deal being okay than, the deal being having very thin margins and everything has to possibly go right in order for me to get a return. So that's how you fill in the vacancy losses here. And then you've got your net rental income after that. Now, down here you have miscellaneous other income or additional income streams. If we were renting, parking spaces at $100 a month and I had 10 of them, I could go in and say, okay, well, we'll have, 70% of those leased at any given time, and I could add that in here. Or if you had, what's really popular in multifamily is like laundry rooms. So, whatever income you'd collect from that. This is basically anything that wouldn't technically be rent for a tenant. So, if you had any beverage machines or something like that in the lobby, or coffee machines, you count that. So this will then give you your total net income. You can actually see right here that I have 3% annual increases. That's actually already baked in to the gross potential rent right here. You'll see in this formula, it's 1.03%. If you wanted to change that, if you feel that your rent growth is more aggressive, just come in here and change it. So 1.03 is 3%. So if I wanted to say it was 3.5%, we just change it to 1.035, and you can see how that affects everything there out. Now, you would have to come in and change it in each one of these subsequent tabs, but that's not that big of a deal. And then down here, it'll show you what your rent per square foot is. So given those increases, by year 5, you'll be at $18 a foot. Well, I know in 5 years, if my rent's only at $18 a foot, I'm being pretty conservative. So I think we're pretty good to go there. As far as operating expenses go, now, again, I own a commercial property management company, so we have operating data and history on what it costs to operate a building like this. If you don't have that, I would reach out to a commercial property manager in your area that is managing a building that is very similar to this style, because every building is so different, right? Like, this is a 9-story office tower. I'm not going to call a group that just manages industrial, because they're going to have no idea how much it costs to maintain an elevator. So there's very specific aspects of managing a property like that you really that you've got to keep in mind. So the expenses per square foot here, I actually based this off of what it costs to manage a high-rise office building in Nashville. So I think I'm being a little conservative. It costs about $7.50 a foot. Average in Nashville in operating expenses for a renovated tower of this style. So that includes, everything from common area utilities to maintenance to property taxes, building insurance, elevator maintenance and repair, all of that kind of stuff. Now, you can get super detailed and break that out if you really want to. Sometimes your investors may require you to do that. I've never experienced that. And that's probably because I'm coming from a, property management background where, people know that I know what I'm talking about. So I don't really have to break that out. Now, typically I'll go in, I would say anywhere from $1 to $1.50 a foot higher than what I think it's going to cost. Because again, you never know what could happen. You may end up having a massive, your HVAC units go out and that expense goes up, and there's all sorts of things that could go wrong. You never know. So since we're going through a major lease up, the building's completely vacant, I'm expecting the majority of the spaces to be leased by the end of year 2. Now, what I'll do is you can either copy the formula in here, or you can just come in and type in what you think it'll be. So once we're stabilized, property management will be handling most of it. I would imagine, we'll be doing, let's say it just costs us about $10,000 a year in commissions. Well, not that. Forget I'm using a Mac. All right. So expenses as a percent of income, that kind of gives you a good high level, how we're looking. If your expenses are over 50%, it's probably really aggressive. You can see in year 2, it's relatively high. Again, that's because we're getting stabilized. And commissions are super high this year because we're getting it full. So as it should be. Now, one thing to take into account too, that as far as expenses go, I have, let's see, in this one, it's actually not taking into account the full expenses in year 1 because the building's empty. there's not going to be a whole lot of people in there. So I've actually discounted that for this side, but you'll see it ramps up to the full expenses once the property's full. NOI just breaks down what your net on income is. So you could see, this is obviously after all of your expenses have been paid. This is what you will be bringing home, and that's what the value of the property will be based on, that's what you will use to calculate the value of the property with cap rates. Under here, you'll have your debt service coverage ratio, which is what lenders will want to see. So you'll see it's very low in the beginning. Again, we're going through an aggressive lease up. But most lenders want to see a 1.2 to 1.25 debt service coverage ratio. So getting to 1.92 in year 3, 4, and 5, being conservative, is a pretty good number. Now, after your operating expenses, you have non-operating expenses. This will include your mortgage interest, which is obviously the interest that you're paying to have a mortgage, principal reduction, asset management fees if you have one. Obviously we go through a lot of capital raises. I raise capital and buy these properties with my investors. So we have an asset management fee in order to organize the asset and manage it from a higher level, distribute K1s, keep, taxes, all that kind of stuff. Capital reserves. Now, depending on the quality of the building and how much upfront renovation I'm doing, this will be on a commercial building anywhere from 15 to 35 cents a foot. Again, just depending on if I do a very heavy front load renovation, which is what I'm doing on this property, that's going to be on the lower end because I know that I'm probably not going to have to spend too much. But it's also not a bad idea to have your capital reserves higher, especially going into the property. You want to make sure that you have some money set aside for capital reserves, because you never know what could happen. And again, if the HVAC units blow out, and you don't have enough money in capital reserves to cover that, well, you can't just go without HVAC for your tenants. That you're probably legally and contractually obligated in your lease to repair that for the tenant. In a scenario like this, you're gonna have to go back to your investors and have a capital raise, and that's not really a situation that anybody wants to find themselves in. So I kind of keep this as realistic as I possibly can. Again, $6,000 a year, that's not a whole lot. It's our money anyway. So whenever we sell the property or whatever, we can always just distribute this back to the investors. But it's a good safety net, building up at $6,000 a year to make sure that we've got some money set aside for a rainy day. Now you'll notice here on the principal reduction that it's blank the first year and it's only 50% the second year. Now I've got that set up because I'm assuming we're going to get 18 months of interest only on our payments here. Now, if you don't, if you're going full term starting out, you just come in here and you delete that, and then you would look at what that is. Okay, so that's H26. So we'll just come in here, add H26 back in, so you can just see, what that'll do. Now, if you're getting, 12 months interest only, you just turn that to 0 and you go full term. And year 2, the great thing about this is it's very editable. It's very easy and straightforward to use. So then down here you have your total non-op expenses. Now under profitability, this is where you start, because you've got to distribute cash to your investors, right? So this is where you actually split it up between you as the main investor or the GP and what the LP will get. So you'll see what the property's return on investment is, the cash on cash return. And then right under here, you'll see a reallocation percentage. Now the reallocation is basically the promote. That's what you as the GP get for taking the deal, putting it together and running it, right? So, I've seen this go anywhere from, 10% equity of the property all the way up to 60 or 80%. It just completely depends on the deal. In this one, I'm assuming, we're going to take 20%, again, for putting the deal together. If we were going to take 30, just implement 30, and it will change it all the way across the board. And then this actually shows how much of that money is being reallocated to the GP. So if you wanted to know how much you would make, in year 3 as the GP, you can just look right there. You'll be bringing in $42,000 a year. Not bad for one deal. Investor cash flow. So underneath that, it actually has the number of the amount of cash that you're going to be distributing to your investors, and then it has their cash on cash return immediately under that. Now that is the investor cash on cash is probably my number one metric when I'm underwriting a deal, because I want to make sure that if I can't be getting them at least an 8% cash on cash return, it's probably not a deal worth doing, because I know I'm going to have a hard time raising capital for it. This one obviously is 11.05 as soon as we stabilize, which is excellent. I mean, that's really good. I mean, that'll outperform most other investment options that your investors will have. Now, coming even further down, you'll see that it has, I've got, the value at a 7 cap. You can change that. You just change it right here. Let's say we think it might trade at an 8 cap. I think that's super conservative. Now, obviously, you'll have to come in here and trade that over to an 8 cap as well. But that changes the values that you'll see here. Right here, you'll have your price per square foot of what the building would sell for. And then this tab, I've got it labeled as net refi proceeds, because I'm going through a BRRRR here. So this would actually be closer to 73%, because we're going to leave 25% equity in the property when we refi. We'll probably take a 1% refinance fee as the GP for going through that whole process. And then I'm assuming the lender is going to want 1% as well. So that leaves 25% equity. So the net refi proceeds is 73. So after we pull that cash out, we're going to pay off the loan. We'd pay off the capital accounts. The capital accounts that's the money that you raise from investors. So then you'll have your total profit from, this says sale. Obviously, we're going to do a refi here, so I'll just change that. And then there's actually a sample $100,000 investor, what it would look like if they got, what their returns would be. They would own 7.78% equity in this investment. And it looks like in year 5, when we refinanced, they would get all of their money back plus, $20,500, which ends up being about 49% total profit. So annualized returns 9.9%. So in this scenario, they would be getting 9.9% on average over 5 years, with an IRR of 10.78%. Now, the beautiful thing about this for the investors is that they're staying in the deal. So they've gotten all of their money back, they've gotten a return, and they're basically getting cash flow after the fact without having any money tied up into it. So that's kind of the nice thing about this deal. So I would say, this deal's a pretty good one. I mean, this is definitely something that I would consider and start pitching to my investors. One thing to make note of too, you'll notice that in years 1 and 2, we have a negative return. We're actually losing money. And that's because we still have operating expenses. We still have a mortgage and interest that we have to pay while we're trying to make the project successful. So you'll see we don't really start cash flowing until year 3. So we have a negative dollar amount that we have to account for when on the front end raise. So this at the very top, there's an operating capital tab that actually takes those numbers into account, and that will show you how much you need to raise in order to not only carry the mortgage and interest for a bit, but any negative operating expenses you'll have until you're ready to go. So what you'll see here is we need about $900,000 for closing, which is a pretty relatively easy raise considering the investment terms for these investors. And I would say, yeah, this is a deal that I would do. If you have any notes or anything like that, maybe you're riding with partners, you can come over here and just change our financing assumptions. Let's say we're going for 20% with an 18-month IO period. That way, whenever I share it with somebody else, they come in here and see it. They can kind of see, okay, well, this is kind of what he was accounting for during that process. Now, one thing that I think is really interesting, and this is one of the greatest things about having these spreadsheets, is that you can come in here and just start tweaking it to see how much little things will change. So let's say over the 5-year period, let's say we actually start out at $17.50 a foot. We determine after we've gotten the property that $17.50 is market and people are willing to pay that. But nothing else changes, right? Everything else stays the same. I come down here, look at that return. So we actually start cash flowing year 1, which means I don't have to raise as much capital on the front end. And then it becomes a 16% plus cash on cash return for the investors. Now, look at their annual, look at their IRR. I mean, just $1.50 a foot more on the rent changed it from a 10% IRR to it almost doubled their returns just by going up $1.50 a foot. Now, let's change the cap rate. I mean, to be honest with you, an 8 cap on a 9-story tower in downtown Chattanooga it's just not going to happen. That's way, way, way too low. So I would say you're probably going to be in the 6.5 to 7 cap range. Let's just say it ends up being a 7 cap. Let me change this real quick. So look at that now. Now we've added another 4% to the investor's IRR. Now this is a deal that investors will get extremely excited about. I mean, because you look at those returns and you take into account how conservative everything else is, and you're good to go, right? I mean, why wouldn't they want to invest in that? Now, one other thing too, let's say you decide not to do the BRRRR method. You decide actually, hey, we're just going to flip it. We're gonna renovate it, stabilize the asset, and then we're going to sell it. If you were to sell it, let's say you've got 6% in commissions. I don't think that you would be paying a full 6% on a $6 million sale. But let's say you've got 6% commissions and then 1% in closing costs. So you're walking away with 93%. Now look at that IRR. It's almost a 31% IRR. Now, this doesn't take into account what the investors are going to have to pay in capital gains. So that's certainly something to consider when you're going through that. The nice thing about doing a refi is that you don't have to pay any taxes on the money that you pull out, but it certainly doesn't hurt, right? Let's say we stick to the refi. And we do end up getting 7%, but let's say our operating expenses come in 20% higher. So that's going to put us at $8.40 a foot, which it's a pretty big increase. Cash on cash return is 11%. So what you guys can see is I'm stress testing the deal right now. I'm going through all these quick scenarios. I can kind of look at it and be like, okay, well, if the market shifts this way, what is it going to look like? And you can see, it's still a 15% IRR. That's a phenomenal return. Now let's say it ends up, we can only get $16 a foot, and then operating expenses are still significantly higher. You look at it and you're like, okay, 6% cash on cash return. Nobody's going to get really too excited about that. What if I say, okay, well, as the GP, since it's not that great of a deal, but we still want to make it happen. We still believe in this. We'll give the investors more for their money, more equity for their money. So we'll change it from 30 to 15%. Well, now it gets up to 7.5% cash on cash returns with a 6% IRR. So, I probably still wouldn't do that deal. You'd probably have to sell it. Yeah, see, if you sold it, then that deal would work. But it depends, again, on what your investors want. Maybe they do want to hold it for the long term, and they're fine with the basically getting all their cash back and then just cash flowing. I know plenty of guys who all they want are, 10 to 12 different projects that give them an annuity every year. But that's pretty much it. You can kind of see how I come through, and I like to stress test my projects. It makes a big difference whenever you're going through the process to be able to show your investors that you have thought through literally every possible scenario, because, they're counting on you as the knowledgeable individual to really make the investment successful. So that is all I got, guys, for how to underwrite commercial real estate deals. Here in the next few weeks, I'm going to be getting together with Bruce Petersen, the apartment guy who helped me put this spreadsheet together. He's actually got a very robust multifamily spreadsheet that we are going to dive into. and I want him to show you how he underwrites his multifamily investments and how to utilize his spreadsheet. If you guys are interested in the underwriting software, you can find that at tylercobble.com/models. We have the multifamily one from Bruce. We've got the commercial one from me, and then you can actually get a bundle. If you guys have any questions on how to underwrite commercial real estate deals, please leave me a comment in the leave me a comment in the comments below, and I'll be sure to get back to you. But otherwise, we'll see you next time.